Good afternoon. My name is Dallas Kriebel, and it's my pleasure to welcome you to our 2024 Green Industry Outlook webinar. Before we begin, a few technology tips. To access the GoToWebinar control panel, click the red arrow on the upper right-hand corner of your screen if it's not already visible, and it will expand the panel. You can click on the various tabs to control your webinar experience. You can type in questions at any point, and we will ask them following the presentation. Click the triangle on the question tab to expand the question box where you can type in your question. Please note that today's webinar will be recorded and archived for future viewing. The recording will be posted at farmcrediteast.com/webinars. Please allow 24 hours for us to get that recording posted. Now, we are pleased to welcome our presenter, Dr. Charlie Hall. Dr. Hall is a professor in the Department of Horticultural Sciences at Texas A&M University and holder of the Ellison Endowed Chair in International Floriculture. His major areas of specialization include strategic business management, financial analysis and benchmarking, and the economic situation and outlook for firms throughout the green industry, as well as conducting consumer behavior research regarding plant and landscape purchases. Dr. Hall is the founder and lead instructor of the EAGLE program, the only executive education program designed specifically for nursery and greenhouse growers, as well as the founder of Your Market Metrics benchmarking program for the green industry. So without further ado, let's turn it over to Dr. Hall and let him share his screen.
Awesome. Thank you very much, Dallas. I appreciated that intro. Hi, folks. This is an annual event that we have, so it's good to be back with you. Some of you hear me annually. You've probably been with me the last several years and doing this Outlook talk. Others of you have probably heard me at other venues throughout the year, and you know that I have a basic format that I follow. I try to talk about what's happening in the green industry, specifically over the last year. And since we just finished up 2023, it's a good time to take a stock of how 2023 went for the green industry. And then I'm going to move into, all right, is there anything that's going to mess us up for this year in terms of the economy? And I'll give my economic outlook, including kind of a mini recession forecast at the end. And I'll try to leave some time for Q&A, and I've got the question panel open myself. I've got the chat box that's open as well. And actually, when I open the chat, that closes no, I got them both open. So I'll try to keep tabs on the questions and the chat to see if there's something that pops up pertinent to what I'm talking about at that moment. If so, I'll go ahead and answer it. If not, then Dallas can take all the questions at the end, and then we'll answer those. So, all right, with that, let's go ahead and get started. Let me look at the first slide here, get that going. All right, here we go. The first slide is one that you have seen before. I have shared this with many audiences. It's one of the only sets of data pertaining to the green industry that the government publishes, the Bureau of Economic Analysis, which keeps track of all the income related metrics related to the end consumer, as well as the expenditures for the end consumer. And what you see here is the flowers, seeds, and potted plants expenditures by the end consumer since 2016. All right, so this is straight out of GDP. I mean, I have done nothing with the data other than presenting it here, with the exception of the black line here is a regression line fit through these data, and the red line is a 12-month moving average, which is basically to smooth out the seasonality that's associated with our industry. So this particular chart, again, shows from the end user perspective, people that are consuming flowers, shrubs, and trees, and in this case, flowers, seeds, and potted plants, this is what they're spending on those particular categories. Now, two things. Number one, I can already guess what the question is on your mind. Charlie, where in the heck is the shrub and trees? All right, well, the shrub and tree data is embedded in private domestic investment numbers, still part of GDP, but I can't separate those out. So since I can separate these out specifically to the green industry, I'm kind of using it as a proxy, but it just shows that prior to the recession, I mean the recession caused by the great shutdown from the COVID pandemic, that right here in the middle of the screen where I've got my cursor, this is pretty much when the pandemic started. And you can see to the left over here, we were growing as an industry, but growing rather glacially, very slowly. That's not by surprise, or not any surprise, because we are in the mature stage of the industry life cycle, which is a very pivotal point within any given sector within agriculture and even outside of agriculture, in that when an industry is in the mature stage of its life cycle, it is imperative for firms to be relying on a solid value proposition that they are articulating very plainly to their customers, whether it be a B2B customer or a B2C customer. And if that particular industry does not do that, it usually enters the decline stage of the industry life cycle. So you can see right here, the pandemic starts, and then of course we see this 30-degree, 35-degree slope here increasing from what it was prior to the pandemic, and sales of flowers, seeds, and potted plants start going up, and going up considerably. Then in 2022, they started leveling off, but much of that was going on was somewhat weather related. And then it enters in a growth phase again, and then plateaus in 2023 at a higher level. Now, you say, dang, this is pretty good. And one of the things, the other thing I need to point out is that these data are adjusted for inflation. So it is like comparing apples and oranges through the years here, apples to apples, oranges to oranges. This is the actual expenditures adjusted for inflation. So you can see the trend. Now, here's the caveat. I don't really have a good feel how much of this growth on the right-hand side of this chart is related to units versus the sales price increase. And our industry, like every industry in America, is part of that inflation dilemma that the country's facing. We raised our prices just like everybody else. And so some of this gain that we're seeing on the right-hand side is price related. But I don't know how much is price related, right? I can't separate that out because we don't really have a good database in terms of the units that were sold. Now we do on floriculture crops, and you can develop a model in which to sort out the units. My good buddy Marvin Miller at Ball Horticulture does a lot of analysis on the floriculture crops report and the Census of Ag report, and that's been reported in Grower Talk. So you can go over there and take a look at some of that information. But the fact is it's been pretty good. Now, when Dallas was introducing me, she mentioned that I'm the founder of two major programs, the EAGLE program, which is the Executive Academy for Growth and Leadership. It's like an executive MBA in the green industry, right? It's green industry focused, and it's a year-long program that basically gives you everything that you would need or you'd be taking an executive MBA program, but it's tied to the green industry. Now, spin off from that, we do strategy, marketing, and finance, and a capstone as part of this EAGLE program. But in the finance program, several of the Eagles that have gone through that over the last 12 years said, can't we start collecting some benchmarking data in which to see how we compare to each other? I said, absolutely. And so we started collecting some of that. Now we have 70 growers. Some of them are Eagles, some of them are non-Eagles, but there's about $3 billion worth of sales from those 70 growers that are involved in this Your Market Metrics program. So what we're seeing here is the gross sales and the net sales from the Your Market Metrics program. The 2023 is not in there just yet, right? So we're seeing the end of year 2022. So going up through these years, 2015, 16, 17, 18, 19, 20, there's 22 right there. So sales are at 2.9 billion in 2022. They were down slightly from 2021. So, but that's a pretty good trend line. The green is the 12-month moving average. So it's not dipping, it's flattening off, but it's not dipping any. And it's, again, significant growth through those years. Now, while 2021, right, was not quite, the sales was not as quite as high as 2022, I still contend that 2021, just like I said last year, 2021 was the best year ever in terms of the green industry, because when you look at the net profit, right, this is the next slide, net profit, then you can see the profits that were made in 2021 relative to 2022. Well, what the crap happened in 2022? A couple of things. We saw input prices increasing dramatically during 2021 and 2022, and then there the weather patterns in 2022 were not favorable for our industry at all. But there were folks that were increasing price, but they weren't increasing price enough to cover 100% of the input cost increases. And I'll show you what those were here in a second. So whether you're looking at net profit from a total firm perspective, or over here on the right, you look at net profit from an FTE perspective. And if you're not familiar with that term FTE, it's full-time equivalent. So you take all your full-time workers, add them up, and then all your part-time hours divided by 2080, which is the number of hours a full-time worker works during the course of a year, and that gives you a full-time equivalent. So you had your full-time workers plus your full-time equivalents all together, and that would be kind of a good picture for the number of people that you're hiring during the year. And some of the sales and profit figures for some of these growers are spectacular. Others, not so much. And I'll show you the why right here. Because if you look at the range of net profit, this is firms 1 through 68 here, right? So a couple of firms weren't in the mix whenever this chart was put in 22. So you can see in 2019 is the blue line, and there were some firms over here on the left that this is firm number. It's not the number of firms. This is like everybody that's in the database, and you can see there were some firms that were making some really outrageous net profits, right? And then it comes down, and you got some folks that are in the double-digit range right there. Now we're getting down to single digits with the blue line, and then it crosses zero into negative. So here we are in 2020, right? Things are starting to pick up. Once we were deemed to be essential, things started picking up in 2020, and then 2021, you see a higher level of net profits than 2021. A little less, fewer people making the outrageous net profits, but then you had also some that were making negative profits, but fewer of them, right? And then we'll move my panel out of the way temporarily. And then 2021, you saw 2022 is the red line. And of course, you had some, even in 22, when the weather sucked in most parts of the country, you had folks that were making a decent net profit, and then you had some over here on the right that were negative, right? So again, this is what I'm saying, that these are individual firms, 68 of them during these years. Some had outstanding levels of net profit. Some had not so outstanding levels, negative profits in these years. And these are some of the best years in the green industry history that ever. And I remember I grew up in the industry in Western North Carolina since I was, I don't know, 12 or 13. Right. And so you got 50 years worth of experience on my part. I've yet to see the industry really increase this quickly, so fast, and the net profits increase. And so we're finally starting to make some money, but you can't expect that to go indefinitely. All right, let's couple of other grower benchmarks here. There's the sales per FTE. On the right hand side, you've got payroll. Obviously, it's our biggest input cost, right? And you can see that payroll dollars increasing at an increasing rate there in some years. Even in 2021, when we had the best year ever, we had $100 million worth of shrink. Now, shrink is always that low-hanging fruit. And the very first thing I look at when I go into someone's business and I look at their numbers, I look at shrink. And if they don't have shrink numbers, I tell them we got to talk about shrink because that's the low hanging fruit. And then if shrink is below the average, then they're in good shape. But if it's above the average, then I tell them that's what they got to look at. So transportation cost, working capital. I've had a big emphasis on working capital. A couple of new benchmarks that I put into the system this year was an aggregate working capital ratio that's comparing your basically current assets and current liabilities, tweaking it slightly. But that ratio, as long as it's greater than 1, means that at least we've got a favorable working capital ratio. But notice in 22, it was just right at, slightly below 1. And then I've got a new metric that I'm calculating, the average working capital days of coverage. And what I'm doing here is I'm taking the working capital, the actual working capital for all these firms combined, right? All 70 firms combined their working capital. And I'm saying if we were to enter an economic downturn that was really as bad as the Great Recession and there was fewer dollars coming in fact, if there were $0 coming in, how long could businesses in our industry survive covering their cost of goods sold and their SG&A expenses? Oh, how many days could they survive? So I calculate an average cost of goods sold, average SG&A. I divide that by 260 business days during the year. And basically, if you take everybody's working capital in the industry, they could go 126 days without any injection of sales or any capital from anywhere and survive based on the working capital they have. That was relatively pretty good, but there's some folks that are smaller that are influencing the overall level here, 126 days, and that box store growers, for example, are usually less than 45 days. But you got some smaller grower, maybe grower retailer type of firms that could go a whole year. So this is just the average, and I'll show you the median once I get the 2023 data in. Now, another metric that I oftentimes talk about, and indeed I write a bulletin called the Index of Prices Paid by Growers, and that's published on the American Hort website in the Knowledge Center. Also, there's a number of trade magazines that publish this. I changed the weights, or I updated the weights of each one of these line items that growers use to produce flowers, shrubs, trees, and basically the weight of what percentage each one of these line items represent of their total cost of goods. But I've got some other things that are more SG&A related or overhead related that are in here. But these are the main cash items that growers have to pay for. So I've got all these included. And you can see through the years, when I changed the weighting, it changed the importance of each individual input here, and it changed my numbers. So some of these bottom line numbers are a little different, slightly different, but different than what I've been reporting in the past because I've updated the weights. Why? Look at labor. In the last 5 years, I've been using labor a weighting of 35% because labor is generally 35 to 40% of sales and 30 to 35% of cost of goods. So, but now since labor cost in agriculture have gone up 25% since 2019, 25%. The employment cost index shows that labor for non-agricultural firms has gone up 18%. So everybody in agriculture, everybody in horticulture is basically at a cost disadvantage because of the fact that you got the H-2A rates, the adverse effect wage rates that are influenced by the USDA's Farm Labor Survey. And when those H-2A rates go up, that tends to be a draw and draw the wages up for domestic workers. So when the next time Farm Labor Survey is conducted, wage rates have gone up, therefore they raise the adverse effect wage rate again. It's a vicious cycle. That's why in 2021, when the federal judge struck down our proposal to tie the adverse effect wage rate, the H-2A rates, to the employment cost index, just like for non-agriculture firms, when they struck that down and went back to the survey, this is the result. Labor goes up 25% relative to 18% for non-agricultural firms. We still got to work on that from a policy standpoint. So you can see in 2023, though, input costs increases slowed down dramatically. So dramatically, only a 0.5 percentage point increase in 2023 in input cost. Even with labor, the other input costs were vastly mitigated, right? The cost of containers went down, lead times went down, cost of media, it still went up, but not as much as what labor did. But you got some reprieve on some of these other items. And so on average, the input cost in 2023 are going up or went up by 0.5%. Now, what's it going to do in 2024? Usually when I do this talk, I give you a forecast of what the next year is going to be. But the confidence interval is so wide when I do that in this time of the year that I decided to wait till June, and I always do an update summer supplement in June. So right before cultivate and right before the trade shows, when growers are starting to negotiate prices with the input with their input dealers, the manufacturers and distributors, I'll update that. And I don't foresee that it being very, I don't think it going back up to 8 and 9%, but it may go 1.5%. For sure, we're going to see fuel and energy go up because we're already starting to see that happen this time of the year. We've not even reached summer, which is the time of the year that gas prices normally go up. So the conflict in Gaza is having some impact on worldwide prices, but mostly it's reduced production coming out of Russia. And obviously the Russia-Ukraine conflict. So a lot of these geopolitical things influence our industry indirectly through commodities prices, and that's what we're seeing. Now, on the retail level, let's switch retail here for a second. This is data that Danny Summers from the Garden Center Group shares. We share data back and forth just to get a feel for the industry. I've given you a feel for the growers. Now let's talk retail. So you can see that the revenues last year in 2023, you can see the seasonality. We make it in the spring and we give it back in the fall. And the name of the game is to give back at least as possible in the fall. And you can see the differences in the table up here by region of the country. So you can see all the negatives here, negative, 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 negative. It's only the Gulf Coast that's basically even in the Southeast, but Ohio, what the crap is going on in Ohio? That region has been very strong in terms of retail sales. At least it was all throughout last year. So you see it in terms of revenue, you see it in terms of transaction counts, right? It's not the customer count, but transaction counts. And so transaction counts, you may have a customer that has multiple transactions during the year, of course, but those transaction counts were up in a couple of the regions, Ohio again, the Southeast, but you had some regions that were negative. And that was 23 compared to 22. And so if things were down in 23 and the weather really sucked in 22, then you know that there were some other issues going on in that region as well, weather or demand related or what have you. The average ticket, the average sale, again, very high in the spring, goes down in the summer, high in the winter. The garden centers oftentimes have 25% of their sales in the Christmas season from Thanksgiving on. So it's a very important time for garden centers. And you can see that the negatives, big negative in the Southeast, but again, Ohio and the Gulf Coast were positive there. All in all, kind of a flat year. And the data from the Your Market Metrics, there's a retail side of Your Market Metrics. Again, gross sales were up 35% from 23 over 2019. So, but for 23 versus 2022, they were down 1.5%. But I don't like just putting the 1.5% there. I remind people, don't be panicking just yet, because if you look at where we're at today relative to 2019 pre-pandemic, it's still we're 36% ahead. That's an important thing to keep in mind. Same way on the customer count. The customer count was down, but compared to 2019, it was still up 9.4%. Margin dollars, gross margin, down 2%, but relative to 2019, still up 39%. Labor dollars, labor is same phenomena. Labor costs, whether it's ag or non-ag, have gone up. And the average ticket, basically flat, but still 24% above what it was in 2019. Now, let's talk box stores for a second, because there's a number of folks on the line that sell to box stores. And if you look at Home Depot revenue, look at the 10 years from 2014, we're at 78 billion, and in 2024 is 152 billion, twice a decade of growth. The sales to Home Depot, and I'm using Home Depot as a proxy for all box stores, because this same trend, you see growth, pandemic hits, and then look at the explosion, right? Then you see it tailing off. And that's why you hear on the earnings calls down here at the bottom, the green and the red, the 4 straight quarters negative of year-over-year growth. And on the earnings calls, it's like, oh man, things are so tough. Year over year has gone down yet again for this quarter. And it's that if you hear them, it's like the end of the world. But if you again, you got to remind them, wait a minute, your revenue's at $152 billion. And before the pandemic, it was $108 billion. And you can't grow this is like a 60-degree growth rate in Home Depot revenue during the pandemic. You can't do that forever. So at some point, you're going to have negative quarterly year-over-year comps. So I don't have much sympathy right there, because they're still doing a lot. And even if you look at their EBITDA, right, there's top line. Look at EBITDA. Let me go back. Top line, EBITDA. Same, look at the top chart here. It's the same curve, right? And EBITDA pre-pandemic, $17 billion. And now in 2024, this projected to be it's just shy of 25 billion. Last year is 27 billion, okay? So that's a final number, 27 billion compared to 17. So they're $10 billion to the good on EBITDA, earnings before interest, taxes, depreciation, amortization. Basically, It's not net profit, but it's not a gap concept, but still EBITDA. We always talk EBITDA, so it's still very favorable. And yet, box stores are pushing back on our growers, saying, well, don't even come in and ask for a price increase. And it's like, it's just so short-sighted. Anyway, here's a couple of slides that I've got showing from 2013 up to 2022. Two things I want to point out. Over here on the second bar from the top is indoor garden. If you go down to the 1, 2, 3, 4, fifth line down is outdoor garden. Now, ironically, indoor garden also includes lawn and garden equipment, mowers, blowers, and so forth, right? So indoor garden and outdoor garden. Now, let's go through time. 2014, they're still holding steady there. 2015, outdoor garden slips a little bit. 2016, indoor garden has the most revenue of any department in the whole daggum Home Depot store nationally. All right, so that's pretty impressive. Outdoor garden has slipped a little bit. Outdoor garden slips even more. Indoor garden is still top. But remember, the equipment is right there in indoor garden. 2018, same thing. 19, 20, 21, indoor garden still up there. Outdoor garden's climbing up, and then it slips back down in 22, and that's where the data ends, right? It's in 22. But my point is that indoor garden and outdoor garden represent 14, $15 billion worth of sales and $10 billion worth of sales respectively. It's a big chunk of Home Depot's revenue, right? So we're a big player in there, but they don't necessarily treat our industry like we're a big player in their stores. We don't get the respect that we deserve in terms of that. My humble opinion, of course. Now, what's going to impact the green industry going forward? Well, let me stick right here for a second. Overall growth of the economy. I usually have about 3 or 4 charts showing this. I'm circumventing that because I'm already at 33 minutes and I want to leave some time for Q&A. So the overall growth of the economy, GDP, third quarter last year, 4.9%. Are you freaking kidding me? 4.9%? How does that happen? Well, it's called the Bipartisan Infrastructure Act. It's called the CHIPS Act. It's called the programs that were put in place, the policies that were put in place to stimulate the economy have been working. We've been creating jobs, and I'll talk about that in just a second. Fourth quarter last year, 3.2%. It's close to 3.3, right? Still phenomenal growth. Now, the first quarter is always going to be negative because we always blow it out in the fourth quarter. And then the first quarter is a little bit of a lull. And that's pretty much going to happen in 2024. But the second quarter of this year, we're coming on it, 1st of April, second quarter this year, right in the heart of the lawn and garden season, is projected to be pretty good, right? Depends on a lot on what FOMC decides about interest rates, but right now the stock market looks pretty good. So there's some headwinds, but not a lot of them. And I'll get to those here in a second. So supply chain, the supply chain's back. You look at the New York Fed's global supply chain pressure gauge, and we're right at the average level of risk within the supply chain as what we normally do. And during the pandemic, that shot up. Of course, lead times just went crazy. The cost of moving products through the supply chain was outrageous. All that's kind of normalized. I mean, there's still some pockets in the Suez Canal and the Panama Canal have their backups and so forth, and that there's some things to still work out, even in the midst of the geopolitical conflict in the Northern Europe and in the Middle East. The supply chain's been remarkably resilient in spite of those. So I'm not too worried about the supply chain influence on our green industry input costs, which just rewind 3 years ago, And much of the cost increases that we saw in those inputs that I showed you earlier, 50% of that was supply chain oriented, right? And then supply and demand, other supply and demand dynamics accounted for the other 50%. So I think the supply chain influences on input cost is basically nil at this point, except for peat moss, right? And the weather influences and the shortages we see on the peat moss side. Now, that's kind of a unique characteristic to that sector. Labor, I don't have any better news for you in terms of labor. The cost, the best, I guess the best news from an owner's standpoint, business manager standpoint, is that the cost of labor is slowing down. The rate of that increase is not as fast as what it was, but at the same point, the higher wages allow more disposable income, and disposable income translates into sales of flowers, shrubs, trees, and landscape services. So, it's which side of the fence are you on in terms of whether that's good or bad. But labor availability, there are fewer than 9 million jobs available, but there's still about 1.4 jobs for every person looking for a job. So that situation is not getting that much better. So those of you on the call, if you're trying to hire people, for every job you have open, what that translates to is that you've got 0.7 people looking that would be available for filling that job. So it's tight, and it's getting better, but it's still tight. So I don't have a fix there, other than saying that the manufacturing sector is the jobs that have been created through the manufacturing sector and the stimulus policies that we put in place in terms of the Bipartisan Infrastructure Act. That's created a lot of jobs, and we've hired a lot of people, but there's not as many people available to work as what there were. Now, I already talked about the cost of inputs. We won't go there. Housing. I do want to talk about housing. And so I'm going to do a focus on housing here in a second. I'm going to talk about inflation, and I'm going to talk about the recession that may or may not be coming, and then what the end consumer is doing, right? So I'm going to finish up with some charts in these 4 areas and then do some Q&A. Now, number of 25 to 35-year-olds. This is causing a boom within the housing market and will cause a boom going into 2030, right? So we have a bunch of 25 to 35-year-olds. The number of millennials millennials represent 38% of all home buyers right now. The oldest millennial is 43 years of age. And so you see this many people coming down the pike that are going to be needing homes. That translates into a latent demand of about 1.7 million units that are going to be needed annually to meet this demand until 2030. Now, this is a pretty powerful diagram. So 1.7 million units, you see how many units we've been producing since the Great Recession, the recovery through the Obama years, Trump years, Biden, and you see the growth in the housing sector and the slowdown in 2022, but then 23 that picked up, and the end of the year date is not in this chart, but it picked up. And then if you look at the latent demand, it's going to cross this dotted line, which means there's going to be a demand for flowers, shrubs, and trees around every new home that's built. That drive demand filters back to growers, right? So it's a really good picture. Now, inflation, the media likes talking about consumer price index. And the consumer price index is one market basket. The personal consumption expenditures index, this right here, is a different market basket. And you can see the two are correlated, and they look very similar as I go back and forth here. CPI, PCE, CPI, PCE, both of them, they look at the last 12 months, right? The core and the headline have been going down. And you can see that it's getting closer to the 2% target that the FOMC, Federal Open Market Committee, uses in making a decision about whether to raise or lower rates. And so it's projected that the FOMC will start lowering rates in May, ceteris paribus, holding other things constant. Now, there's pundits that'll tell you, no, they're going to wait till June or July. I'm just reading tea leaves myself. And so if they do start in May, then it's going to be 25 basis points. And many are projecting a 75 basis point decrease in interest rates. Mainly, if you look at PCE, the same trend here, except the headline is actually less than the core. That's unusual, and but they're still approaching that 2% target, the red line right there. So instead of 75 basis points, there are some, including myself, that think this may be closer to 125 basis points. That once they start, when they start, they'll continue at 25 basis points, check things out. And if we don't see a spike in inflation, a renewed spike, then it keep going down. So we'll see how this plays out. But basically, we should see a reprieve on interest rates because of this inflation is going down. Now, this next chart is this line here is what you and I and everybody else spend. This is the personal consumption expenditures. These are the data in which this PCE index, you take the expenditures and the price levels, and this is the expenditures part of it, right? And so you see the expenditures up through Obama and Trump years. You see the pandemic, it slows down, and then the Great Recovery, and then we've been spending like nobody's business since then. Now, notice the disconnect. I got it here in the box. Notice the disconnect about how we feel and how we spend. And I've said this before on this webinar, and I've got the insets over here. This is the University of Michigan Consumer Sentiment since 2020. You see in some months we're feeling good, and then depending on what newscast we're watching, we feel bad, and then we feel good, we feel bad. And same way with the Conference Board's Consumer Confidence Index. This is a line graph down here at the bottom, and you can see sometimes we feel good. The pandemic hits, we feel bad. We feel good, we feel bad. Then as the recovery starts, we're feeling good. Then we feel bad again. This is bouncing all, how we feel bounces all over the map. But look at how we're spending. Look at this. I mean, we spend regardless of how we feel. Now, how we feel is that there's a very weak correlation here in terms of how we feel and how we spend. So this is what I want us to focus on, this over here on the far right-hand side. Interestingly, I got this other inset right here. This is the folks that are asked about how they rate the economy. And the blue are the folks that identify as Democrats. The red are all the folks that identify as Republicans. And they're asked a question, what is your view of the condition of the national economy? And you can see that right before Trump was elected, Democrats are feeling good, Republicans not so good. Excuse me, 1 second. All right, then Trump is inaugurated, and look, it's magic, it flips. Republicans feel good about the economy, Democrats, their opinions going down. And then the pandemic hits, and you see all this flipping. Biden's inaugurated, and all of a sudden the enthusiastic Republicans think we're going all of a sudden the economy magically just tanked, and then all the Democrats felt that it was tanking, that they feel good about the economy. I don't have to say anything else. That's called a mic drop right there. That's a mic drop graph right there. And I don't have to say one way or the other. And I don't care whether you're on one side of the fence or the other. I'm saying I don't care how you feel. I care how you spend your money. And right there, you see it. People are spending their money. So you can't say in the green industry that people don't have the money, because look here. This is real consumer spending. Now I'm keeping tabs on my watch, and you break down expenditures here by discretionary income, or not discretionary expenditures, and non-discretionary. You know, we got to pay our mortgage, got to pay our health costs and so forth, and we got to pay for food. Discretionary is all these things that we have some flexibility in whether we spend or not. And if you look over here on the right, this is all the discretionary spending that's broken down here. And you can see in this bar, let's go over to the right. The blue portion of the bar in terms of our discretionary spending, which you can see is roughly about 4% year over year change, right? It grew at 4%. Non-discretionary grew at 2.6%. Where did it grow? The biggest part of the bar is recreational goods. This is bicycles, this is boats, this is trampolines, you name it. Then food services and accommodations from travel, right? That's the second part of the bar there. Automobile and parts, what we spend on our cars right there. And then recreational services. These are our golf club memberships, our gyms memberships, and so forth. See, you got well over 2/3 of the bar here in these discretionary spending items. Another mic drop. Flower, shrubs, trees, landscape services. Are these? They're not non-discretionary as much as we would love them to be non-discretionary. People spend regardless of whether the economic conditions. That we know that they're discretionary items, and yet they're up here in the tiny pieces of this bar versus some of these other, the spending on recreational goods, you know, spending on boats and so forth. So don't tell me people don't have the money. Again, we see how they're spending their money. So that's that's they're spending the money. That's my point. And the recession, these indicators here, I'm not going to go through. These are 4 different indicators that I've talked about in this webinar that are on my recession dashboard, right? And none of these are showing recession. There's 2. Number 1 being the yield curve, right? We got a negative yield curve and with an inverted yield curve. And that generally, when it's all the purple here, is when there's been the recession that happens when the yield curve is inverted. And we've been inverted now for, I think it's 19 months that it's been inverted. And you can see all the years historically and how many months it's been since when the yield curve started to be inverted and when the recession occurred. The average is 14 months. Well, according to the yield curve and the inversion of the yield curve, we should have had a recession 5 or 6 months ago. But right now, the New York Fed yield curve model has a 58% probability of recession occurring between now and this time next year. The Cleveland Fed, a little bit higher, about 65% probability of recession occurring between now and sometime next year. Remember, we got an election somewhere between there. I think those are a little inflated in terms of those probabilities myself, because in an election year, it's a lame duck year. We generally don't get a lot of policies that are put in place that are going to upset the apple cart, except when we don't pass a budget. Now that's a whole different story. The leading economic index is also continuing to signal recession. This is a lagged indicator. So you can see the from December, when December ended, the leading economic index, which is a foretelling of the economy a year from now, it was still negative, right? In terms negative growth, but then it was starting to increase. The 6-month growth rate was starting to increase, even though it was below the red lines here, which is the recession signal. But it's starting to come back and positive and go above that recession signal. So it's very mixed. Is it on the way or not? Is there going to be a recession? Quite frankly, the chances of a soft landing are getting higher in my mind. But again, I'm not worried about this spring in the green industry because of the way people have been spending their money. Now, I got put this graphic of the national budget over here just to remind me to say we got to continue kicking the can down the road, or maybe Congress could even do their job and pass a daggone budget rather than continuing resolution ourselves to death like we've been doing for over a decade. So, but we can't default on our loans, right? We can't go off the fiscal cliff. And then this chart down here says in the long run, we're going to have to do something about the debt levels within the country. But those are situations that aren't, of course, the budget is facing us continuously, and we think we have a plan in place in terms of getting to at least to the end of the year before we have to face this decision again. It's a whole other thing, and I don't need to get in that can of worms right now, but we will have to face the national debt at some point. So what's my take-home points? Number one, stay calm, breathe, maintain a longer-term perspective. Yeah, remember that people are spending their money right there. People are spending their money. Yeah, there's a lot of rhetoric on TV. There's always a lot of rhetoric. And depending on which channel you're watching, if you're only watching one channel, you're doing yourself a disservice, right? You need to have a well-rounded input into your brain. So, but people are spending their money. So maintain that longer-term focus, right? And then number two, SOPs, manage your efficiencies, and for goodness sake, manage that working capital. Now, while I'm going through my take-home points, you can see the QR code over here on the right. You can take your phone, put that up to your monitor, and you can download these PowerPoint slides right now, right? So they're also going to be on the website later with the recording, but if you need them right now, the actual PowerPoint file, you can download that by using that QR code. All right, so manage that working capital. That's a big focus. And I'll be talking about working capital for several years because this is where I see all the firms that have been going out this year. You see in the trade press, the firms going out of business. It's not that they didn't grow quality plants, it's that working capital caught up with them. That's the key, right? And to maintain that working capital, you got to have some profits and retained earnings. So you got to hold the line on pricing. That's number three. You got to hold the line on pricing. And there's a lot of pushback by box store buyers right now, a lot of pushback from garden centers, and landscapers are even pushing back a little bit. Don't give in to it. Hold the line on pricing, right? Focus on your value proposition and articulate that value proposition in a way that people get it. So let me go back over and I want to quit sharing my screen, but I can't see the panel. So there it is. All right, quit sharing my screen. And Dallas, were there any questions? Because I lost my panel there for a while, so I didn't see if there are any questions there.
I am not seeing any questions, Dr. Hall.
All right, we'll give folks a second to type those in the chat box or the question box. Because I keep hearing a bell and I keep thinking it's a question that's coming in. All right, so I'm not clairvoyant, but I can sense that this is a highly intellectual crowd that's here online today. And I know that that if your question was to come in, that it would probably be something in the neighborhood of what can we expect for 2025 and beyond, right? You've told us, Charlie, that 2024, that spring is not necessarily going to be derailed by the economy. And of course, we got a November election. How's that going to play out for 2025? Well, I'm glad you asked, right? Well, first of all, we know from that partisan chart that I showed you, that little inset on the consumption chart, that whatever the outcome, there's going to be half the people that are going to be feeling good about the economy and the other half aren't. right? So that's just the nature of the divisiveness within our country right now. But the underlying factors in manufacturing, and you look at the labor market, and I don't see any major changes that are occurring that would necessarily upset the apple cart. All right. So while the Fed's probability model, just looking at the yield curve, still shows recession, and the leading economic index still shows recession. And even I myself, for these last two webinars, I said there's about a 50% chance of a recession occurring. I really haven't necessarily backed off of that, other than maybe it's 40-60. Maybe I think there's only a 40% chance. In other words, I'm thinking right now that this soft landing may actually come about, but a lot of it depends on what the FOMC does with interest rates, and as long as the consumer keeps spending. Now, there's some weaknesses that are showing up. There's some more money that's being put on credit cards, and that's what happened right before the Great Recession. We saw leveraging of the end consumer. But right now, it's not at levels that are, red flags in terms of any Great Depression or Great Recession happening again. All right. Any other questions that came in? I don't see any.
We do actually have one.
Okay.
What impact do you see fuel prices having in 2025, particularly here in the North?
Yeah. And in fact, if you go over to, let me answer this by giving you a great resource, and it's EIA.gov, right? And I'm typing that in myself. In fact, let me share my screen again, and can you make that happen, or do I need to?
Just a second.
Okay. All right, I'm going to show my screen again, and this is EIA.gov, right? An Energy Information Administration. Then you go to short-term energy outlook. And I know let me make my screen a little bit bigger there. All right, so this short-term energy outlook, and you've got a forecast for 2024. If everything was to hold constant with where we are right now, then the dollar per barrel, the Brent crude oil price, would be $87 average for this year. And again, because of the Gaza conflict, we had a $4 bump in the price of oil. And when the Lebanese and Syrian terrorist groups started sending rockets into the travel corridors there, we had another $4 bump. So far, Iran has stayed out of the mix mostly. And so if Iran jumps in, you're talking about a $64 barrel increase. You're talking about worldwide recession. That is a major geopolitical event that could cause some major upheaval. But barring that, you'll see an $87 average. But what's projected now in the EIA's model, and they use best case, worst case, and middle scenarios, is about $85 a barrel, which translates into $3.45 at the retail price. That didn't show diesel, but it's there's a correlation there between regular and diesel. So 348 for this year is what's projected, was slightly down from last year, although we're seeing it go up, so that may change. And then it's not projected to be higher next year. It's actually projected to be lower. So, and natural gas, and you're talking about the Northeast, natural gas, you've got some increases in 2025 that are expected. So what I'm thinking, if I'm in the Northeast, I'm looking at my natural gas expenditures, and I'm really thinking about my futures contracts on natural gas and mitigating that risk, and going short on that, short or long, using the futures to mitigate this price increase on natural gas. Because interestingly, there's a strong correlation between natural gas and fertilizer prices, but fertilizer prices are a much lower percentage of our cost of goods sold than natural gas prices are. And so that could be an influence in 2025. I'd be looking to mitigate that price, the price outlook there, the increase in price outlook for 2025 on natural gas.
All right. We are at time, but we do have one more question if you have
Okay.
a minute. All right. Last question. Wondering if you're seeing an effect on B2B sales of trees and shrubs related to the amplification of agroforestry projects as a result of USDA's climate smart commodities programs.
Yeah. That's a great question. I don't know the answer to that. I really don't. I'll just say this, that if you look at the climate mitigating policies that are put in place that involve tree planting, that's an opportunity for our industry. We have to be very aggressive in tackling that opportunity. Here's why. The green roofs, the green infrastructure movement, the portion of the green infrastructure movement, and the green roof opportunities have been satisfied by the construction industry, not the horticulture industry. So we've lost some of the opportunity that green roofs provided. This same thing could happen to us if instead of planting nursery trees, they plant trees that Georgia Pacific and other foresters have been producing, and they plant little itty bitty pine trees versus trees for rural and municipal landscapes. All right, so we have an opportunity there. And while I don't know the answer to your question, I think our industry needs to be aggressive in really pursuing that opportunity. And I know there's some folks in the Midwest that are right now very successful in capturing some of those contracts. In the Northeast, I'm less familiar with any success stories. So again, there's an opportunity there. Thanks for that question.
All right. Thank you so much, Dr. Hall, for that informative presentation.
All right, you're welcome.
All
Thanks for
right,
being here, folks.
Yep. As a reminder to everyone, all Farm Credit East webinars, past, present, and future, live at farmcrediteast.com/webinars, and the recording of today's webinar will be posted there for future viewing. Thank you all for your time and attention today.